Everyone thinks buying a home in 2026 is the safest investment you can make. But the truth about what's happening in these 10 American cities is absolutely wild. Your equity isn't just shrinking. For thousands of homeowners, it has already vanished. Stay with me, because number one on this list isn't just losing value, it's losing buyers entirely.
Something uncomfortable is unfolding across the American housing market right now, and it's not showing up on the evening news. While headlines still talk about high prices and stubborn mortgage rates, a very different story is playing out beneath the surface, in neighborhoods, zip codes, and metropolitan areas that boomed loudly during the pandemic years and are now correcting just as loudly. We're talking about cities where inventory has exploded, where sellers are slashing prices week after week, where investors have quietly vanished, and where ordinary homeowners are watching equity they spent years building simply disappear. This isn't a prediction. This is what the data is already showing us in 2026. Today, we're walking through 10 American cities that are experiencing the sharpest, most painful housing corrections in the country right now, ranked from serious to severe. Each one tells a different story about how a market overheats, how speculation fuels dangerous disconnects, and how the unwind always comes eventually. If you own property in any of these markets, or you're considering buying in one of them, this is information you absolutely need. If you find this valuable, hit subscribe and drop a comment telling me which city you think hits its absolute bottom first. Let's get into it. Number 10, Memphis, Tennessee. We start in Memphis, a city that never quite made it into the pandemic housing conversation the way flashier metros did. But that's exactly what makes what's happening here so striking. Memphis didn't attract armies of remote workers or institutional investors bidding properties up to absurd levels. Instead, it drew in a quieter wave of small landlords, out-of-state buyers chasing low price points and high rental yields. The pitch was simple: cheap homes, desperate renters, easy cash flow. For a short window, it worked. Now it's falling apart. Drive through neighborhoods like Whitehaven or Raleigh today, and the visual cues are hard to miss. For sale signs cluster on blocks where turnover was nearly non-existent 5 years ago. Many of the homes have visible deferred maintenance, roofs that need replacing, driveways cracked and heaving, paint jobs long overdue. These aren't cosmetic complaints. They're signals of landlords who bought on thin margins and are now losing the ability to maintain what they own. The numbers confirm the stress. According to Atom Data Solutions, Memphis now carries one of the highest foreclosure rates of any major metropolitan area in the country, with approximately 1 in every 650 homes currently in some stage of foreclosure proceedings. That's not a rounding error. That's systemic financial distress filtering through an entire market. Meanwhile, population data from the U.S. Census Bureau shows the metro area has experienced net out-migration for 3 consecutive years. Fewer residents means fewer renters, fewer buyers, and less demand to absorb the growing pile of available inventory. Median home prices have slipped roughly 7% year over year. Not catastrophic on its own, but when paired with rising property taxes, climbing insurance costs, and vacancy rates creeping above 10% in several neighborhoods, the margins that once made Memphis attractive to investors have effectively disappeared. Memphis is a reminder that cheap doesn't always mean safe. Number 9, Jacksonville, Florida. Moving east to Florida's northeastern corner, Jacksonville presents a market caught in a genuine squeeze, pressed hard from both sides at once. During the pandemic years, Jacksonville marketed itself as an affordable alternative to Miami and Tampa. It worked. Builders responded aggressively, developers broke ground on thousands of new units, and buyers flooded in. The problem is that demand has cooled dramatically, while all that new construction is now delivering and hitting a market that simply can't absorb it. Active listings in Duval County have surged over 90% compared to 2 years ago.
That kind of inventory expansion is the kind that changes the psychology of an entire market overnight. Buyers, sensing the shift, have pulled back and started waiting for better deals, which creates a self-reinforcing cycle of price cuts and lengthening days on market. The insurance situation only makes it worse. Like much of Florida, Jacksonville is experiencing a homeowners insurance crisis. Several carriers have exited the market, and those that remain have raised premiums by an average of 38% over the past 12 months, according to the Florida Office of Insurance Regulation. When a buyer calculates their true monthly payment, mortgage, taxes, insurance, HOA, many simply walk away from deals that otherwise might have closed. Pending sales are down 31% year over year. Price reductions have appeared on nearly 45% of active listings. And the builder community, which helped create the oversupply problem, is now competing directly with existing homeowners, offering rate buydowns and incentive packages just to move inventory. Jacksonville isn't collapsing, but it's bending hard under the weight of too much supply and too little demand, and the relief valve isn't visible yet. Number 8, Denver, Colorado. From Florida, we head to the mountains. Denver spent the early 2020s becoming one of the most sought-after relocation destinations in the country. Outdoor lifestyle, a booming tech scene, and relatively reasonable prices compared to coastal cities drew in tens of thousands of new residents and sent home values soaring. That momentum has stalled, and in many pockets of the metro, reversed. The correction here ties directly to what's happened in the technology sector. Denver became home to satellite offices, remote work transplants, and startups that rode the same wave as larger tech hubs. When layoffs began rolling through the industry and return to office mandates tightened, a meaningful portion of the buyer pool that had propped up prices quietly evaporated. According to the Denver Metro Association of Realtors, median sale prices have fallen approximately 11% from their 2022 peak. Days on market have stretched to an average of 58 days, a stark contrast from the frenzied, weeks-long bidding wars that defined the boom. Inventory in Adams, Arapahoe, and Jefferson counties is running about 35% above the pre-pandemic baseline. Affordability has become a structural problem. Even at reduced prices, the Denver Housing Affordability Index sits near historic lows, as mortgage rates have kept the true monthly cost of ownership painfully high for the typical local household. Many potential buyers simply cannot qualify for what the market is still asking. The rental market, often a pressure valve in correcting markets, offers limited comfort. Vacancy rates across Metro Denver have climbed to 6.8%, with new apartment completions adding thousands of additional units to an already competitive landscape. Rents have declined year over year for the first time in over a decade. Denver is a city that overshot, and it's now working through a slow, grinding reset. Number 7, Las Vegas, Nevada. Few cities in America wear their boom and bust nature as openly as Las Vegas. The city's identity is practically built around risk. But what's unfolding in its housing market right now transcends typical cyclical behavior. Las Vegas attracted a massive wave of out-of-state buyers, particularly from California, during the pandemic. Remote workers seeking larger homes at lower price points flooded the market, pushing values up nearly 50% between 2020 and 2022. Investors piled in behind them, confident the appreciation would continue and rental demand would hold steady. Neither of those assumptions held. Clark County now shows active inventory running 42% above last year's levels, according to the Las Vegas Realtors Association. The absorption rate, the time it would take to sell all current listings at today's pace, has climbed to 4.7 months, the highest reading in over a decade. At the peak, that number was under 1 month. The median sale price has declined 9% over the past year. More telling, the sale to list price ratio has slipped to 95%.
meaning the average property is closing $15,000 to $25,000 below its asking price. That gap represents the daily reality of a market where buyers have recaptured negotiating power they hadn't held in years. Foreclosure activity is escalating. Adam reports that Nevada has one of the highest foreclosure filing rates in the western United States, with Las Vegas driving a significant share of that volume. Adjustable rate mortgage resets are forcing many investors who stretched during the boom into impossible positions. Monthly payments have spiked while rental income hasn't kept pace. Short-term rental saturation has compounded the problem. The number of active Airbnb and VRBO listings in the Las Vegas metro grew explosively during the boom years. Now, as travel demand normalizes and competition intensifies, revenue per available unit has dropped significantly, pushing hosts to exit and list their properties on the regular sales market instead. Las Vegas rolls the dice every cycle. Right now, the house is winning. Number 6, Sacramento, California. Sacramento's story is deeply tied to the remote work era. When San Francisco and the Bay Area became too expensive even for high earners, Sacramento positioned itself as the logical escape hatch. 2 hours away, dramatically cheaper, and newly accessible to workers no longer required to commute daily. The city's population surged. Prices followed. Between 2020 and early 2022, Sacramento posted some of the fastest home price appreciation in the entire state of California. The reversal has been swift. Return to office pressure has eroded Sacramento's core advantage. Workers who relocated discovered that a twice-weekly commute to the Bay Area is financially and emotionally exhausting. Many have either returned to the Bay or are at least reconsidering Sacramento as a permanent base, reducing the buyer demand that once made this market so competitive. Inventory has more than doubled compared to 2 years ago. Redfin data shows that approximately 38% of active Sacramento listings have seen at least one price reduction in the past 30 days. The median sale price is down roughly 10% from peak values, which is particularly painful for buyers who entered the market in 2021 and 2022. Many of whom are now in near zero or negative equity positions. Condo and townhome segments are taking the sharpest hits, with values off as much as 15% in some neighborhoods. Single-family homes in outer suburban communities, the ones that specifically attracted remote workers seeking space, are also correcting meaningfully, as the lifestyle calculus that drove purchases there has shifted. Sacramento isn't broken, but its pandemic-era premium is being rapidly repriced out of existence. Number 5, Charlotte, North Carolina. Charlotte sits at a fascinating crossroads in 2026. For years, it was celebrated as a success story, a Sunbelt city attracting corporate relocations, financial services employment, and steady population inflows. Unlike speculative boom markets, Charlotte's growth had tangible economic drivers. So why is it showing up on this list? Because even fundamentally strong markets can overshoot, and Charlotte overshot. The pipeline of new construction that responded to peak demand conditions has continued delivering homes into a market where buyer sentiment has shifted dramatically. There are now more finished homes on the market than at any point in the past 12 years. Builder incentives, rate buy-downs, free upgrades, closing cost contributions are now standard practice across new construction communities throughout Mecklenburg and Union counties. Active listings have climbed 65% compared to 2 years ago. The median days on market has lengthened to 52 days. And in a significant psychological milestone, the percentage of listings with price reductions recently crossed above 40%. Corporate relocation activity, which once served as a reliable engine of demand, has slowed. Several major financial institutions that announced Charlotte expansions during the pandemic have since scaled back or delayed those plans as remote and hybrid work arrangements reduced the need for new physical capacity. Median prices have edged down approximately 5% year over year. That decline may sound modest, but in a market that appreciated 40% during the boom,
A 5% nominal decrease masks a far more significant real value correction when adjusted for inflation and carrying costs. Charlotte isn't in crisis, but it's in transition, and the buyers who entered the market near peak prices are feeling it. Number 4, Salt Lake City, Utah. Salt Lake City's pandemic-era surge was one of the most dramatic in the country, and its correction is matching that energy on the way down. The city attracted a wave of tech industry workers, largely from California, who saw Utah as a high-quality alternative with significantly lower housing costs. That perception was accurate for a window of time, but the buying frenzy pushed prices to levels that made Salt Lake City one of the least affordable housing markets in the nation relative to local incomes. From its 2022 peak, median home prices across the Salt Lake metro have fallen approximately 16%, according to the Utah Association of Realtors. That's a sharp, painful decline, especially for buyers who stretched financially to enter the market at the top. Inventory has surged. Months of supply has climbed from a historic low of under 1 month at peak to over 4 months today. That shift has handed buyers significant leverage, a concept completely foreign to anyone who tried to purchase here between 2020 and 2022. The remote work dynamic that fueled Salt Lake's rise is now working in reverse. As companies tighten return to office policies, some transplant residents have reduced their commitment to the area, adding supply through properties being listed as second homes or investment properties get sold off. The condo market is under particularly intense pressure. New developments that were launched during peak enthusiasm are completing delivery into a market where demand has fallen sharply, creating localized oversupply in the urban core. Salt Lake City's correction still has room to rise, and the residents who know it best are watching nervously. Number 3, Tampa, Florida. Tampa was one of the hottest markets in the country during the pandemic. Retirees, remote workers, and investors all converged on this Gulf Coast city simultaneously, pushing home values up over 60% in less than 3 years. The reversal has arrived in force. The insurance crisis that's damaging markets across Florida hits Tampa with particular severity. Hillsborough and Pinellas counties face some of the highest flood and windstorm insurance premiums in the state, and those costs are rising every renewal cycle. For many buyers, the insurance line item alone has made ownership financially inaccessible, regardless of what the purchase price reflects. Active inventory in the Tampa metro has climbed 120% compared to 2 years ago. That staggering increase reflects both sellers rushing to exit before costs escalate further and investors unwinding positions that no longer generate positive cash flow. When acquisition cost, insurance, property taxes, and HOA fees all rise simultaneously, the investment math simply stops working. Median sale prices are off roughly 11% year over year. Nearly 55% of active listings have undergone at least one price cut in the past 30 days. And the average home is sitting on the market for 75 days before going under contract, a dramatic slowdown from the sub-2-week sales cycles that characterize the boom. Short-term rental operators are feeling pressure from multiple directions: increased supply, reduced travel demand, and new local ordinances restricting short-term rental activity in residential neighborhoods. Many operators are converting vacation rentals to long-term units or exiting entirely, further swelling available inventory. Tampa remains a desirable city with genuine long-term fundamentals, but in the near term, it's in a painful correction that will likely take several years to fully absorb. Number 2, Dallas-Fort Worth, Texas. Dallas-Fort Worth may be the most important housing market in the United States right now, not because it's the most distressed, but because of its sheer scale. What happens here ripples through supplier chains, investor portfolios, and builder balance sheets across the entire country. The DFW metro absorbed enormous demand during the pandemic years. Corporate relocations brought thousands of high-earning households. In-state migration from Austin, Houston, and other Texas cities added more. Builders responded with historic levels of new construction, and that construction pipeline never stopped. Today, the inventory of newly completed but unsold homes in the Dallas-Fort Worth metro stands at its highest level since the immediate aftermath of the 2008 financial crisis. That's not a statistic to gloss over. It represents tens of thousands of properties competing for a buyer pool that has contracted significantly as mortgage rates have remained elevated. Total active listings across Tarrant, Dallas, Collin, and Denton counties have risen over 80% compared to 2 years ago. Builders are deploying aggressive incentive strategies, rate buydowns to the 5% range, tens of thousands in closing cost credits, free premium upgrades, because standing inventory represents real compounding carrying costs. Median sale prices have declined approximately 8% from peak, but averages obscure specific pockets of the market that are experiencing far steeper drops. Outer suburban communities and master plan developments that attracted peak cycle buyers are seeing corrections in the 12% to 15% range. Investor activity has pulled back sharply. Institutional buyers who were net purchasers just 2 years ago have become net sellers, quietly unwinding positions as their assumptions about continued rent growth and appreciation haven't materialized. Dallas-Fort Worth has the economic diversification and population momentum to recover, but the oversupply correction now underway will take years, not months, to work through. Number 1, Miami, Florida. Miami claims the top position on this list not simply because of declining prices, though prices are declining. It earns this spot because Miami in 2026 represents the confluence of every major force that destabilizes a housing market simultaneously. A luxury bubble deflating, an insurance system fracturing, climate risk being repriced, and speculative foreign capital withdrawing, all at the same time. During the pandemic, Miami reinvented itself as the new financial capital of the Western Hemisphere. Hedge funds relocated. Crypto billionaires bought penthouses. Celebrities and tech founders planted flags. Every month brought a new announcement of another company moving its headquarters to Brickell or the Design District. Prices responded predictably, surging to levels that turned Miami into one of the most expensive cities in the country by median price-to-income ratio. That narrative has quietly reversed. Several financial firms that relocated have since downsized or renegotiated their commitments as the cost of operating in Miami, driven by real estate, insurance, and general cost of living, proved higher than projections anticipated. The crypto industry, which generated outsized demand at the peak, has contracted significantly. Foreign buyer activity, while still present, has declined sharply as a stronger dollar and international economic uncertainty have reduced purchasing power. The insurance crisis in Miami is existential in a way that's difficult to overstate. Several major carriers have stopped writing new policies in South Florida entirely. Citizens Property Insurance, the state-backed insurer of last resort, is under significant financial strain. Condo owners are facing a compounding crisis. Insurance premium increases are hitting simultaneously with massive special assessments required under new state building safety laws enacted after the Surfside collapse. Owners in older condominium buildings are receiving assessment notices for hundreds of thousands of dollars in mandatory structural repairs and reserve funding, costs many simply cannot or will not pay. The result is an extraordinary surge in condo listings. In Miami-Dade County, active condominium inventory has risen over 170% compared to 2 years ago. Many units that hit the market are doing so out of necessity. Owners who cannot cover the assessments and insurance have no choice but to sell, regardless of price. But buyers willing to step into that liability are scarce. Median condo prices have declined 13% year over year. Days on market for condos have stretched past 110 days in several zip codes. Transaction volume has fallen off a cliff. In some of the city's most iconic buildings, properties that attracted celebrity buyers and made international headlines, closings have nearly ceased. The luxury single-family market isn't immune either. Properties priced above $5 million are sitting for extended periods, with price cuts becoming increasingly common on listings that would have sold within days at the peak. The aspirational premium that Miami commanded, the idea that this city was somehow different, that it had escaped the constraints of typical market cycles, is being systematically repriced. Climate risk is now a visible factor in buyer calculations. Flooding during seasonal weather events that previously went largely unnoticed is being documented, shared on social media, and factored into purchasing decisions in ways that simply didn't happen 5 years ago. Buyers are asking different questions than they used to. They're researching elevation maps, they're running flood risk models, they're reading actuarial data, and in many cases, they're deciding to look elsewhere. Miami will not disappear. Its weather, culture, and international connectivity ensure it remains a globally relevant city. But the extraordinary premium the market was charging in 2022 and 2023, the idea that ordinary supply and demand rules didn't apply here, is being methodically dismantled. For buyers who stretched to enter at the peak, this correction isn't an abstraction. It's a financial reality that will define the next decade of their lives. What this journey across 10 cities makes clear is that the 2026 housing reckoning isn't a single event with a single cause. It's a collection of corrections, each city carrying its own specific pressures, but all pointing in the same direction. Inventory that accumulated during years of speculative overbuilding is now meeting a buyer pool that's constrained by affordability, squeezed by insurance costs, and increasingly patient. Sellers who expected to hold price are learning that the market they sold into no longer exists. And investors who underwrote deals on assumptions of perpetual appreciation are discovering that gravity always reasserts itself. Understanding which markets are correcting, how deep those corrections are, and what's driving them isn't just academic. It's the difference between making a well-timed decision and getting caught on the wrong side of a major wealth transfer. If this breakdown gave you a clearer picture of where the American housing market actually stands in 2026, show some support by liking the video and subscribing for ongoing data-driven analysis. Drop a comment below. Which city do you think hits its floor first? And which market, despite the current pain, do you think is actually building toward a better entry point? Stay informed. The numbers are telling a story. Make sure you're reading them correctly.